Hi friends, and welcome to another episode of Arctic Money. This time, portfolio update for winter 2025. Let's get into it immediately. First of all, let's start with the upper left corner. These stocks you see in front of you right now at the moment today represent 78% of my net wealth. So I am heavily invested in this one. I have skin in the game. About cash situation, lower left corner, I have none basically. I'm almost fully invested at the moment. Let's check first the positions I have currently. You can see that a couple of positions have been sold since my last update. Origin Enterprises sold, Dr. Martens sold. I think those are the biggest sales I have made, which means that there are differing percentages in the current holdings of my portfolio, so let's get into it. Flow traders, I have increased my exposure to 34%. That's actually a pretty big one. Flow traders, a liquidity provider from the Netherlands, and should do well in the times of volatility in the market when the VIX index spikes up. When will VIX index spike up? Well, that's the beauty of it. I have no idea, and nobody has any idea. That's why it is so hard to make a valuation on flow traders, because volatility is something that cannot really be modeled at all. I would say it cannot be modeled at all. But one thing is for certain, in my opinion, there will always be turmoil in the market. There is always next catastrophe that will happen. When will it happen? I have no idea, as I said, but this is me positioning in a market where overall I think the market is not cheap. There are cheap companies. That's why I have also other positions in my portfolio. This is what I believe. But for example, looking at the market over in United States, it's not, well, I'm not talking about any individual names, but overall, it's, let's say, S&P 500, I think, is overvalued. Maybe not crazy overvalued still, but heavily overvalued. You know, I have been saying this for a long time. I'm still saying it. And let's get back into this a little bit after a bit. First, then, my second biggest position is actually not Kamux with 13%. It's the next three holdings that are all uranium, so Yellowcake, Global X Uranium, and Sprott Physical Uranium Trust. Altogether, these make now 28%, so I have two significant positions in my portfolio, and this is the second one. Still heavily invested in uranium. I believe, of course, that the price of uranium must go higher in the future due to energy demands that the world needs, green energy. If you're interested in uranium or any other stock, please see a video on my channel specifically dedicated to that investment. I won't go deeper now in this video. Then third biggest position, in a way, Kamux, 13%, used car sales in Finland, main market, but then also going international, or has gone international, to Sweden and Germany. The original owner recently returned as the CEO, and the former CEO was fired. It seems to me that the biggest owner, the old CEO, who is again now CEO, Mr. Kalliokoski, made it clear that the company is not considering exiting Germany and Sweden. I believe this is the right decision, even though the talk in Finland, especially in Finland, in the investor community, has been that people would like them to exit these badly performing markets, but I disagree. I think when I know how fragmented the industry of used car sales is in Germany and Sweden, I'm sure there is a business opportunity for a few consolidator businesses, bigger companies that Kamux aims at being. So I believe, yeah, I don't know how this will turn out. This is big risk investment for sure, but I think that there is a clear opportunity for used car sales industry in Germany, Sweden, also in Finland, to see further consolidation. And my belief is that Kamux could be the one benefiting from it. This is the main investment thesis I have. Then I have increased position in Auster, 7%, robotics lidar maker from United States. HIMS, almost similar size position at 6%. These two have seen big stock declines recently, and I have a little bit increased my position thus in Auster, for example, and these two contribute quite a bit also to why my portfolio hasn't done so well recently, because their stock prices have gone down. HIMS, obviously, Amazon of healthcare in United States. Then green landscaping is now 5% of my portfolio. There has been insider buys by the biggest owners of green landscaping recently, kind of contributed to also me increasing my position in green landscaping, and I think the company is very good valued, operates in Sweden and Norway mostly with landscaping services. Interesting company in an interesting, boring industry, and again, same thing as with Kamux, I feel that green landscaping operates in a space where consolidation can happen, and I have one good experience in these kind of consolidation industries. That was the funeral home and cemetery operators in United States, Park Lawn Corporation and Carriage Services, which were good investments to me, was it now 2 years ago, and made a good money with them. So Greg's 4%. Also, Greg's stock price has gone down recently, and biggest fast food chain in the UK. Looking at the valuation, I feel the company is valued really cheap at the moment, because they exist in a space that if you're bigger than Subway or McDonald's in the UK, you really have economies of scale working for you. You must have. And these types of companies are, from competition-wise, really difficult to tackle away from their leading positions. So taking into account how big of a moat I think Greg's has, the valuation, if it's not cheap, it's at least fairly valued at the moment. And then finally, Energy Services of America Corporation, 3% smaller position in my portfolio. Energy Services in the United States, I'm kind of researching the company still, so that's why it has just a tiny exposure in my portfolio. Then Arctic Money performance since when I first time started investing, when I first started investing since 2018, plus 36%, annualized 3.9%. If you ask me if I'm happy with this return, of course I'm not happy. But let's get into that soon. Standard & Poor's 500 with dividends reinvested, so the whole index, if you would have put lump sum, invested all your money, same time I started investing, is up amazingly 175%, annualized 13.8%, which is crazy returns. Crazy, and according to me, not sustainable. I can say it out loud. Then my real benchmark, the person I do want to beat, who I am losing to at this moment, index investor who monthly invests in S&P 500 with all dividends reinvested, is up plus 62%. That's annualized for plus 6.2%. So I'm at plus 36% and my benchmark is at plus 62%. So yeah, this obviously I'm benchmarking myself against the index investor because that's more realistic example who I'm competing against. I didn't have all my money that I have now back in 2018, so it would be kind of unrealistic for me to compare myself to the index itself. But I'm still comparing myself to the S&P 500 index itself too. I want to beat it someday, but first I need to beat my real benchmark, the index investor with monthly additions in S&P 500, dividends reinvested, who is now at plus 62%. So yeah, there was a time a year ago when I was already beating the index investor, but this year has been stagnating for my portfolio. And obviously I thought I was really happy a year ago that this is the moment I leave the index investor behind. Well, it didn't happen. I had worse returns than the index investor, but even though it's frustrating, even though many of you might think that, okay, Christian, maybe you should start investing in the indices too and forget about this stock picking, it doesn't seem to work for you. Well, now I want to conclude this video with something I was talking in ChatGPT about Berkshire Hathaway and Warren Buffett. And I asked the ChatGPT what was the longest. Okay, now first things first, I am comparing because there might be actually a way to compare the index investor to Warren Buffett, but because even though I'm taking the risk of comparing myself to Warren Buffett, let's keep Warren Buffett's and Berkshire Hathaway's benchmark the whole index itself, and I mean S&P 500 with dividends reinvested, competing against Berkshire. So I can tell you that between 1998 and 2008, so 10 years, Berkshire Hathaway underperformed S&P 500 total return index, so dividends reinvested, the same one I'm comparing there on yellow to myself. 10 years of S&P 500 total return index beating Berkshire Hathaway and Warren Buffett. Then 2010 to 2020, again almost 10-year period, the Berkshire Hathaway and Warren Buffett lost to S&P 500, dividends reinvested. And then again, starting from mid-2021 to this day today, which is 3 to 4 years, Berkshire Hathaway lost again to S&P 500. So, as you can see, when I'm now talking about the last 30 years, there has been almost two 10-year periods and one 3 to 4 year period when Berkshire Hathaway has been losing to index itself with dividends reinvested. And still when we compare the whole index to starting from 1998 until this day, so almost 30 years, and taking all of these long periods I just described to you into account, the returns have been for Berkshire Hathaway roughly 1,417%, while the S&P 500 total return gained 1,051%. So by approximate margin of almost 400%, Berkshire Hathaway beat S&P 500 total return index during the last 30 years, even though it has been losing almost 2 times directly 20 years to the index, and 1 time starting from mid-2021 until this day, losing 3 to 4 years to the index. So, as I have been soon investing 8 years, starting from 2018, as you can see there, I think I need to be able to lose to S&P 500 and to the index investor for long periods of times. If Warren Buffett can, during 30 years, have almost 2 10-year periods when he is losing to the index, so can I. And I don't have the numbers here how it would be with Berkshire Hathaway and the index investor, but maybe we can keep index investor as a benchmark to me right now and have Warren compete against the index itself. I just wanted to tell you these numbers because if this kind of periods of 10 years happen during the last 30 years for Warren Buffett, Berkshire Hathaway, when they are losing to index, and everybody knows I just told you how the story then still is turning out. During the last 30 years, Berkshire Hathaway has done better than the total return index of S&P 500. He's still beating the index, so even though losing for these long 10-year periods, that only tells me that I need to be willing to lose too. And I just wanted to share you these numbers and kind of convince myself that even though it's 8 years now and I'm losing even to an index investor, I am not at all getting panicked. I continue with the path I've chosen, and I still believe I will have my returns. If not next year, then some year after 2026. Let's see how it turns out. This is investing, and as you can see, this is one of the most important lessons Warren Buffett and Berkshire Hathaway teaches is patience. If you cannot be patient, if you start panicking now when I'm losing to both the index itself an index investor, you are not an investor. You don't have the mental capacity to it. I want to believe in myself and still do. Let's continue the story and hope, even though that was kind of a confusing explanation to what I told you about Warren Buffett and Berkshire Hathaway and S&P 500 total return index. If you don't believe me, do your own research, but these are the numbers. These are the realities of huge outperformers of the market, the best one ever, the greatest of all time, Warren Buffett, Charlie Munger, Berkshire Hathaway. And with that, I end this video. See you in the next one. Bye-bye.